Hello and welcome. Now, while the cash market closed around 330 points lower, we saw another recovery in the cash segment, which is post 330 up to 340 p.m. And what we saw in terms of the move was a decently sharp move, another 160 points gain by the index today in just those 10 minutes. So that those moves seem to continue, at least on the Nifty. The Nifty IT closed around 0.1% lower. The Nifty Bank closed around 0.5% lower. So you saw recoveries in both of those. As you can see, the levels both on the Nifty IT and the Nifty Bank were lower, at least till the cash segment closed. So that's how it's really shaped up. But let me talk about the movers of the day. And the big movers, essentially, Grasim was down 3 3/4% as a result of the kind of move that we saw yesterday on Grasim. The life insurers, HDFC Life, SBI Life, were under pressure. Bajaj Auto was down 2%. Max Health, Reliance, both down 2% each. And HDFC Bank also saw some bit of trimming, in fact, in trade today, even though those last 10 minutes of the F&O trade seems to have distorted that. Apollo Hospitals, Hindalco and Trent were the top gainers of the day. But, the bigger debate at this point of time is to try and understand, as you can see that spike in Apollo Hospitals, what's happening in the F&O landscape. And Sajid here to break down the F&O queues. I'll also, Sajid, come back to you and ask you a question on what this means from Wednesday's day of trade and that standpoint. But first off, on the queues of today.
Thanks, Harsh. Look at what's happening on the Nifty, closing about the 24,600 mark. Of course, if you look at the way the Nifty has moved in the last 15 minutes of the cash session or closing auction session, you will see that there was a spike which came into being, and that is visible in the open interest which is coming in, because the F&O market closes nearly 10 minutes after the cash market comes in. So 8% jump in the open interest for the Nifty there, and that it gives you a giveaway that there's some shorts that came in the market there. Nifty Bank again down nearly 0.58%, closing just about the 57,900 mark. There's a discount of 183 points. That gives you the pressure which is coming into the futures market, especially shorts that got built up. This 183 points is also an indication of how the F&O market is now starting to react to the cash market closing. And there we have seen the open interest up is 2.58%. And if you look at the individual stocks, there's a lot of shorts that got built up in today's trade, especially in the private banks. HDFC, ICICI, Axis, and Kotak adding short positions, while there were some long positions that came in SBI, Bank of India, and PNB. But look at what's happening in the call and put trading. It was an expiry day for today. Look at what's happening in August 11, which is next week's expiry. We're seeing an active call writing happening at 24,500 and 24,600 and 700. It gives you a good indication of the kind of resistance that's coming in the call. Of course, that 15 minutes trade, which is highly illiquid trade, which at this point in time is creating some aberration with respect to how an expiry is going to end. And with many suggesting that the closeout of position should happen on if it's a daily one before 3:15 and not going into cash. But this is what we are seeing here. The put writing is very minimal at 23,300, 400, and 500. And if you look at the distribution chart for that, you can see that 24,500 is and 24,600 has a good call option. But the markets ended above that level today, and that's what is the distortion which is coming to the market. It will take some time for the market to stabilize because of the liquidity which is coming in. But for now, it's the Nifty about 24,600, and there is a huge call positions which are getting added in 24,500 and 600 level there. In the gainers part, you had KEI where we saw some short covering. The stock up nearly 9.9%. Godfrey Phillips was active in the options side. Again, there's a long position coming in there for 4.5% up. Nalco saw long positions coming in the long in the losers pack. LIC, there's a short position build up 8%, understandable because of the OFS which is open, and also the fact the OFS pricing, floor pricing was around 11 to 12% below the last traded price. So there was a discount coming in, big discount coming in, and that's what is getting cashed in the futures market. UPL short build up happening, IREDA short build up happening there in the futures losers. Open interest gainers include LIC. Look at the kind of jump in open interest for LIC which has come in. Normally this is not a very active trade which is there in LIC, but the open interest build up is entirely a short build up coming in. IREDA seeing 24% jump, and UPL is up nearly 13% on the back of short build up which is there. NHPC, GAIL, KI all up in today's trade, but seeing some shorts getting covered in today's trade. So going into Wednesday's trade, it's a very difficult guess to do, but we have a lot of resistance coming at 24,500 and 600 because of the call writing which is coming in there, but the index is closing about 24,600. So you're going to see again some kind of distortion coming in at the opening bell, especially the pre-open trades which is there between 9 and 9:15, and it will take a few days to stabilize and for the liquidity to come into the closing auction session. But till then, we'll have to make do with what we have.
It's fascinating. I'm going to quickly take a follow-up with you. And what's fascinating is that we were down 330 points in the cash market at 330. That adjustment meant that we gained around 150 to 160 odd points in the last 10-15 minutes of adjusted trade. So do you believe that we make that adjustment tomorrow? Because we didn't see a meaningful adjustment, at least at the start of day today. Do we make that tomorrow? Do we not make it? Any sense on that?
At this point in time, because we are seeing a lot of illiquidity coming into the system, slight positions in some of the bigger stocks like a Reliance or some of the banking pack or an IT pack, which accounts for, and we were talking about it in the morning, that this pack accounted for nearly 40-45% of the weightage. If you are able to put in that bids for those stocks in the last 15 minutes, there is bound to be some change which is there. So as you said, we were down 350 points. We almost came clawed back from that, closing at 0.64% there. But again, the liquidity is something which is important, because based on the equilibrium price which is arrived for those 5 or 6 or 7 stocks which have a huge weightage on the Nifty or Nifty Bank, we have seen the closing price coming at 24,615 levels. So that's one of the big reasons which is there. But again, you'll see that happening tomorrow as well. There will be some more trading sessions where we are going to see this kind of distortion before liquidity comes in, institutional liquidity comes in, and then it stabilizes the entire market.
All right. Thank you, Sajid, for taking us through that. That was on the F&O snapshot for the day. But we now have Darshita joining us to take us through what all cues for investors to watch in the upcoming trading session. Darshita?
Right, here are the top market cues to watch for August 5, and starting off first with the biggest event in India, which is the RBI's monetary policy decision, which is expected to drive the market sentiment. Investor will also keep an eye on HSBC Services PMI for a snapshot of the economic activity. Now, globally, the spotlight will be on the US, where the ADP employment report and ISM Services PMI will be closely watched for clues on the strength of the economy and the Fed's next move. In Europe, the focus will be on the Services PMI and the Producer Price Index. Now, moving on to the earnings front, where the global pharma giants like Eli Lilly and Novo Nordisk will be in focus. Back home, key results are expected from Berger Paints, Cummins India, Aurobindo Pharma, Biocon, GNFC, and GE Vernova TND India. In the primary market, RD Industry IPO opened for subscription, while Manipal Health Enterprises is set to make its stock market debut. And finally, investors will also track the minutes of the Bank of Japan's June policy meeting for any hints on the central bank future policy path.
Okay, thank you so much for that, Darshita. Of course, that's going to be the big one, which is the MPC. But Ajit Mishra of Religare Broking joining us to give us a sense as to how one should make sense of those last 10 minutes of trade. Ajit, let's start off with that. What do you make of that move on the index in the last 10 to 15 odd minutes again today? And what does it mean for markets for Wednesday?
Yeah, good evening, Harsh.
Good
So
evening.
basically, what we are seeing is basically a new normal. Means it's a new system in place, and what Sajid has rightly mentioned, that liquidity is the only thing that is going to clarify on this part, that how often and how much, to what extent we're going to see this kind of move unfold, especially in the index in the last 5-10 minutes of the trade. So as of now, it's a very volatile swings for the traders. And, at least for a time being now, the prudent approach is what we are recommending to our clients also, is to refrain from any, aggressive positioning post 315 until, we see this kind of volatile swings, slows down, and we see rational, closing on the index front. So as of now, yesterday also it was the spot was on the premium, and we are having a similar close in today's session also. And yes, after yesterday's session, today initially it was the downtick in the cash markets. So this kind of volatile swings, at least in the index, is likely to follow until we see more of the liquidity in the system, which participates in this closing auction mechanism, and then probably we'll have a better ground to say that things have came back to the normal. So as of now, it's prudent that we should refrain from any aggressive positioning after 350, in especially if you are trading options, and that too naked options on long or short side.
All right. Hi, Ajit. Meryl D'Souza here, also joining in. You did mention that, liquidity is, of course, going to be the most the major determining factor when it comes to this volatility. But what sort of timeline are you expecting for this new policy to then become more, for investors especially, to get more comfortable with this, or for the volatility to sort of taper down? What sort of time horizons should investors look out for to expect further volatility in the markets to go down?
So, Mel, it's a new system, so obviously it might take some time, because when it comes to the heavyweight, the Nifty 50 counters, all those stocks are the part of this universe of stocks in the F&O basket. So any decisive move, cause 3% up or down, is something which is okay during that this special window. So 3% is huge, especially if we see on a less liquidity, if we see any kind of trade happening. So this may continue. I'm not sure, means timeline is very difficult to comment on that, because it's a new system, and probably maybe a month time, probably we'll have 2-3 expiries also, or weekly expiries, and the monthly expiry also will take place. So probably by then we'll have more understanding how this system is overall going to impact the market closing. So as of now, like what I have mentioned earlier also, that at 315 you just curtail your trades, especially the naked option trades, and sit on the sidelines and see how the markets react in the next day before you make any fresh positions.
Ajit, sector bias, stock bias.
So, Arsh, this is the right approach, especially in the market like this, wherein broadly, if you see that structurally we are positive, means we have reclaimed the long-term averages when it comes to the Nifty index. We have, in fact, surpassed the previous swing high, close to 24,600 mark in the Nifty. So, though the pace of advance is very gradual, so tone looks positive. 25,000, 25,200 is something that we are eyeing in the index next. Banking, financials, metal, auto, these are the preferred sectors basically wherein we see strength, relatively higher strength. FMCG is slightly on the back foot, and other sectors are also on the rotational basis are contributing to the move. So basis that, the first recommendation that we have for the day from the metal basket is Hindalco. if you see, this has been almost a month of consolidation or correction that we have seen in the stock. And today, it was a decisive breakout from the previous swing highs. So 1060 is what we are eyeing in Hindalco as the immediate target, with 995 as a stop loss. And then we have Siemens also, like 4 month of consolidation has finally ended. A decisive breakout, volumes were strong. So we anticipate this up move to continue towards 4300 mark, means a possible retest of the record highs. So with stop at 3850, one can accumulate Siemens also at current levels.
Okay. Ajit, your picks for Wednesday?
So these were the picks, Harsh, like Hindalco and Siemens is something that you should
Perfect.
prefer.
Okay. All right. We'll take that. Ajit, thank you so much for joining us and giving us that perspective. We'll let you go.
Thank you.
Thank you. All right. Now, the theme of the day. And in fact, the government has decided that there may be an MDR, which may come into effect. Now, what this will mean from a UPI perspective, what this will mean from a markets perspective, stocks to focus on. We have with us to discuss all of this Rahul Jain of Daulat Capital. And to start off with, Rahul, great having you. Let me first start off by getting a sense how realistic this removing zero MDR as a provision. How realistic is it? Because there's been just so much debate over the many years on removing this, on not removing this. How realistic is it?
Yeah, I think the entire thought process that why it can be a practical possibility came when last year they decided that instead of paying UPI incentive for the entire volume of UPI that happens here, there was a circular that came in wherein it would be paying only for small merchant less than 2000 rupees kind of a transaction at a 15 paisa incentive on such transaction, while there is an absence of view in terms of what happens to larger merchant. So since that is absent, there has to be some kind of a charge which should come. Currently, there is no such charge, and that's why once this incentive thought process get cleared on what volume, what kind of merchant can be called small merchant, once that definition is defined and last year payouts are made, I think implication of MDR on rest of the merchant can also become clearer.
Got that, Rahul. Meryl D'Souza here also joining in. I want to understand that, well, the government has said that customers won't be charged, but if the merchants do start paying this MDR, could that eventually get passed on?
Yeah, I mean, even if we take the past take rate as a benchmark for a potential MDR, which used to be 30 paisa before it was made zero, it still will be one of the cheapest way a merchant get discounted for any other instrument. If you know, credit card are charged at a much higher rate, anywhere between 1.5 to 3%, depending upon which network, which card, and stuff like that. And similarly, there are fixed charges if you are using other instrument. Even wallets are charged upwards of 1% interchange. So basically, 30 paisa is what we could see on the higher side, 30 bips. And even if we take that into consideration, because this was the rate before it became zero, it will still be the cheapest mode, and merchant should be okay with this kind of MDR because this would be charged only on larger merchant. So the large merchant definition could be around, let's say, 1 crore of annual turnover. So it won't be a significant dent in our understanding.
And how does this benefit, Rahul, the handful of stocks that benefit from this, and one of them being paytm, the other one being mobikwik, even a JioFin could well benefit. How large, how meaningful could the benefit be at the very minimum from the most conservative lens?
So we did some back of the envelope calculation. Of course, we don't know what could be the threshold for the merchant in terms of sizing. We don't know what is the take rate which could be deployed. And there is also a calculation basis that how much will be retained by the payer bank and pay bank and stuff like that. And because Paytm or mobikwik for that matter will be a TPAP, so they would only be retaining a smaller portion out of that total MDR, which will be charged on a net basis. So even taking all the conservative thought process, our calculations suggest it would add roughly 3 to 4 billion in terms of the net gain out of this. And if we benchmark it, the incentive in the past used to be around 100 odd crore at its peak. So versus 100 crore incentive in the past, and this could go all the way to 3 to 400 crore in terms of actual MDR being collected, and this can compound at least 20%, as has been the case on the P2M volume growth, which hovers between 20-25% YOY.
That would be substantial for someone like Paytm, right? Because that will come straight to the bottom line. There's no real cost involved there.
Yeah, so if we look at hypothetically this getting implemented, even let's say next year, this would mean closer to 20% kind of an uptick on our estimate, on our current profit estimate. It could lead to closer to 20-25% jump in our PPT assumption.
Rahul, I also see you track ER&D quite closely. Now we've had that understanding of MDR. I just want to quickly pick your brain on ER&D as well, because KPIT and the likes, because of earnings, some of those names have been in focus. What's the sense you're getting? Because I remember when I spoke with Tata Technologies, and they were suggesting that the lead time to build a car has shrunk just because of AI. Do you believe that revenue growth will accelerate substantially? Of course, depending on client cohorts, etc. But broadly, given AI, or is that a big risk?
Yeah, I think we are talking 2-3 aspects here. If we purely go from the point that the total timeline for the car launch or changes to be made into vehicle has reduced, that's how the cycle has shrunk, especially for the EV native players. And that is what the rest of the industry who are in the ICE market or are also getting into the hybrid or EV model has to gradually adapt to. Otherwise, they would not remain competitive to such players, largely coming from the Chinese OEM side. So yes, there is incremental need for dependence for ER&D player for these large OEMs. So that is one clear trend that they should be beneficiary. Of course, the challenge is that they are seeing a lot of profit warning. They are already seeing a lot of volume drop. So their ability to fund such large program for modernization is the conflicting point. So I would not be able to tell you for Tata Tech because we don't cover that name. But right now, KPIT is seeing a lot of opportunity from the new OEM side and new advancement side, but it is seeing some program slowness that has happened in some of its existing large OEM accounts because they are changing their strategy at this point in terms of whether they want to go for the SGV program or they want to revise their thought process.
Okay. Rahul, thank you so much for coming in and speaking to us. Of course, a longer discussion on ER&D warranted, and we'll probably call you for that a couple of weeks from now. But thank you for that. Thank you for all of those thoughts.
Thank you.
All right, with that completely timed out on this edition of Market Edge, from myself, Merrill, everyone who puts this show together, thanks so much for watching. Stay tuned to ET Now. More action to follow.